Does this really fan the flames of potentially persistent inflation and the negative implications for EMs?
Yeah, we've already seen that emerging market central banks don't quite have the luxury of waiting out what might end up being transitory inflation. So, where the likes of developed markets can somewhat wait on hold and hope that things will fade over time, emerging market central banks have been much more proactive. And certainly the continuing supply issues that we've seen alongside these issues now with oil, where we're seeing things crop up in both the power squeeze in China, India, now even the likes of Brazil. Certainly those issues continue to keep the price pressures on and will keep this transitory inflation going on for longer.
I want to throw up a chart taking a look at the stock performance when it comes to the energy space, right? Because you take a look at energy stocks, they have outperformed all other sectors by just a huge margin. It's not even close here when it comes to even global stocks, not just within the US as well, right? So do you still see opportunities within that space?
We've certainly seen a big move, and definitely I think we see that reflected in oil prices now as well. What's more concerning to me is actually that some of the traditional countries that normally benefit from these sorts of moves with for world, we aren't quite seeing these gains in energy stocks and in oil translate over into positive gains in the emerging market space to the likes of Russia, Chile, Colombia, sort of seeing that improvement in either the FX markets or even local equity markets.
We saw with treasury yields jumping, really Asian assets taking a big hit. UBS, I think, at some point called this the tantrum in Asian assets. Which markets will get hit the hardest if yields continue to rise from here, and at what level does it become really counterproductive?
Yeah, yields have been a big focus of ours, and we actually re-upped a study that we did a few months ago when we were in this situation of rising treasury yields once before. And in general, we find that a 50 basis point move higher in US yields can bring some substantial pain for emerging markets on both the FX side and the local debt side. Now, the ones that are most impacted tend to be the likes of Mexico, Turkey, and Indonesia, three markets that have a lot of foreign participation and also have some other idiosyncratic issues that make them more vulnerable and risk off times. Across the board, though, we do see that generally this isn't a positive for EM. So while that 50 basis point move in treasuries, which now would get up to around 2%, would be pretty extreme, we are looking in the medium term for a little bit of pain, but not quite reflective of a tantrum just yet, given there are a lot of differences this time around when we compare it to the 2013 taper tantrum.
And yet you do have more idiosyncratic risks like Evergrande, surging commodity prices. So could we get, at what point would it become as dangerous as it was back in 2013?
So I think we'll start with the good news this time around, which is that the taper has been very well communicated and projected by Fed officials. On top of that, a lot of emerging some of those external vulnerabilities that made them more vulnerable in 2013. On the negatives, like you mentioned, there are still a lot of idiosyncratic risks to pay attention to. We have seen the market has been able to ignore some of these risks for a very long time, particularly very specific stories like Evergrande. What we're watching going forward is really, we think there's going to be more volatility in these markets. It's not going to be the same sort of risk assets always go up over time story that maybe happened in the rebound from COVID. Now we're in that rockier period that's the post-peak growth, post-peak Fed support, fiscal support, all of those areas that are making for a more complicated picture going forward.